What is up, guys? It's Charlie Marr, and right now I wanted to make a video, a compilation video of Warren Buffett, because I've told you guys many times that I strongly believe there is a three-stage theory to making millions in the stock market. And I've watched Warren Buffett for so long now. I mean, it's been so many years, and I've seen so many videos, and especially like on his annual reports or like on his annual meetings, they're like an hour, 2 hours long, and he drops sudden hints of what he did when he had small money. I always tell you guys, when you have a smaller amount of money, it's not the same how you handle it when you have a lot of money. It's not how so that's the whole point of the video. It's the misconception. It's the mistake people make trying to follow the Warren Buffett now when he has billions of dollars versus what Warren Buffett did when he had thousands of dollars. And it goes within the three-stage theory. It goes into the whole misconception of Warren Buffett. So what I'm going to do right now is pretty much react to the compilation videos that I made of Warren Buffett that just talk about this. So it's going to be very repetitive because he does repeat, he repeats things a lot, but I still want to share them and make comments over them. So that's pretty much what we're going to be doing, and that's what this video is about.
So I bought it very cheap.
I'm gonna start it, and the audio is coming out of my computer, so hopefully you guys hear it fine. If not, I'm sorry, but we'll do the best we can do. So let's go ahead and just start listening.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy
the very first thing. He said it himself. Everybody hears about the cigar butt method and the cigar butt method, and he explained it. The whole point is you're not buying a pack of cigarettes. You're not smoking a full cigarette. You're walking around looking for a soggy cigar butt that has a puff left. And it's for free. You're not paying for this. You find it in the street, you pick it up, you see that it has a little bit on it, and you put it in your mouth, light it up, and smoke it. And then you go and grab the next one, and the next one, and the next one. Now, the thing here is this is exactly how these companies are when you first start off. And you find crappy companies, in this case, a soggy, nasty cigar butt, but you get that extra puff. And that's the same way with these small cap companies or companies that are unheard of. So they're crappy companies that nobody cares about. They're being thrown out, but they're trading below liquidation value. You're buying $1 for 50 cents, and you pick it up and make some money, and then you leave, and then you go on to the next one. He just told you that. And then the other thing, the key word was, he used to do this when he had a small money, and you can't do this with big money. And this is what people always get confused. This is how you make high returns, but the professionals can't make high returns because these small stocks don't move the needle. So let's go ahead and keep listening to the rest of the videos.
Now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks, and Berkshire was selling below its working capital per share. You got the plants for nothing, you got the machinery for nothing, you got the inventory and receivables at a discount. It was cheap, so I bought it. And 20 years later, I was still running a lousy business, and that money did not compound. You really want to be in a wonderful business, because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps.
Okay, so another comment that I want to make there, because that's actually really important. So the first thing is, I always tell people not to do that part. Don't hold stocks for that long. And I gave an example on the last video that I made, that if you had $10,000 and you found Amazon, I think Amazon at that moment was trading for $10 or maybe 150. I have it here in my notes. Let me double check before I sound like an idiot here. Let me see real quick. I'd written it down. So, okay, so Amazon 10 years ago was going for $150. Right now, it trades for $3,200. If you had $10,000 and you were 22 years old and you invested in Amazon, by the time you're 32, 10 years later, your 10,000 would have turned into $200,000. I'm sorry, but that is a very small return for 10 years. Why? Because you invested a very small amount of money. It's different if you invested $10 million into Amazon into that $150 and it went to $3,500. In that case, you would have $200 million, like, or whatever the math is. It's a huge difference. So that's the kind of stuff that you have to kind of keep in mind. And this is why I love the compound thing. You buy a cigar butt, you make 100%, and then you go on to the next one. You turn your $10,000. This is how quickly you get to those 200,000, just to give you an idea, which you're seeing happen in the 100K challenge. Instead of buying that Amazon that makes you 200,000 and turns your 10,000 into 200, and you're up 2,000%, which first of all is rare to find and it's hard. Like, you have $10,000, you put it in the cigar butt, and it goes up to 20,000, and you take that 100% profit, and then you put those 20,000 and you put it in the next one, and they go from 20 to 40, and then from 40 to 80, and then from 80 to 160, and then from 160 you go to 320, and you can do that a lot quicker because you can do 2 to 3 of these a year. I've been doing this since 2015, and I see them like pop out every once in a while. Let's keep watching because I could talk.
Liquidated it and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake.
Okay, so what he's talking about, that mistake, is so those are bad companies. So these are companies that maybe their fair value was at 10, but every year it's losing $1. So it goes from 10 to 9 to 8 to 7. So he's obviously telling you, don't hold those. Time is the enemy of those companies that are losing equity, that are losing money. The stock's fair value could be at 10. You can buy it at 5. But the thing is, if every year it's losing $1, eventually it'll meet up with you. But what I've seen happen, and what I see happen all the time, is that the market kind of values it, or like puts it at where it should be, or a company comes in and buys them out at where they're going through. So there's merges, there's a buyout, or the market just agrees, and you get that cigar puff. On the other hand, if you find a company like this, and instead of going down every $1 on the fair value, it goes from 10 to 11 to 12, you bought it at 5, you're riding that baby all the way up. Eventually it'll just spike, and then maybe it goes from $1, you start buying $1 for, or you start holding $1 that's worth $1, so it no longer makes sense to hold, and that's when you sell. Buy when the value is there, sell when it's not there.
The question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold,
Do these stocks have names?
well said.
Funny how he's like, do they have names? Like, he wants to know the stocks. It's just not his world anymore.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you had to.
So that's something that I tell you guys all the time. The stocks that he's talking about, no one's reporting about them. No one's writing articles. No one's talking about them. No one's sharing them on TikTok, on YouTube. No one's really sharing these stocks because they're companies that no one pays attention. And like he said, there's always a kind of efficiency or like there's always, these stocks are always being overlooked, or something always happens that makes these stocks become available, and you have that opportunity.
You could find out about them, but nobody was going to tell you about them.
Again, the same thing. You can find out about them, but no one's going to tell you. Nobody's going to tell you about these stocks. Again, I look at all the stocks I've invested in. People laugh at me for investing in these stocks. I look at Charles and Kovar. We looked at G3 when we were looking at Rick, when we were looking at WSTL, Playmates. People laugh at your face for looking at these stocks. But first of all, they don't know how to value a stock. They know the price, but they don't know how to value a stock, and that's two different things.
And my guess is that continues to be true. Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically.
This is what I tell you guys all the time. You can grow a lot when you have a small money, but once you get to the millions, that's when things get a little bit harder. And he just said it, many millions. So you could do this with $1 million. He has videos talking in the past that he guarantees 50% return on your investment with $1 million. And I think he even mentioned at a point with even $10 million because those opportunities are out there.
But that's the nature of it. You've got to, when you get up to things you could put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals, and I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise.
That's the only thing here. That's the key word here. Like, you have to be willing to put in the work. No one's going to tell you about these. There's no articles. Like, no one tells you about these stocks. This is why you have to go through hundreds and hundreds of stocks. It's almost a full-time thing. Like, you have to go through so many of them. The beauty of it is that valuing a business is very easy. It takes me like 3 minutes to value a business. And now we have technology these days where, like, I just put in a ticker in my computer and I put in all my valuation calculations are already coded. So it gives me the math right away. I can narrow down the list dramatically super fast. And then maybe I end up with 50 of them, but then I can go through those 50 and then choose, like, cherry pick which ones I actually want to keep. And then I rank them from best to worst.
Very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah, most smart people, unfortunately, in Wall Street figure that they can make a lot more money, a lot easier, just by one way or another, getting an override on other people's money or.
So that's true. That's the sad part of Wall Street. Like, instead of putting in the work and compounding your money yourself, what's the easier thing to do? You go work for a firm, you go manage people's money who already have millions and millions of dollars, and you get 2% of that. Or there's always different fees. Sometimes it's 1%, 2%, 3%. And every time you buy a stock, you get commission. So it's just easier to make money off of those people than you do the work. And the best thing is that you don't take a loss. You don't have you seen Wall Street when he's talking about the the hard cash, like the commission, baby, and all that stuff? And he's talking about like, who cares about making the money? Just come up with another idea and then tell them, oh, this stock's gonna do this and blah blah blah, invest in it. And then you invest in it, they take commission. And like that's the bad about Wall Street. That's why I don't care about analysts. I don't care if you work on Wall Street or work for JP Morgan. It doesn't mean you know what you're talking about.
Or delivering services in some way that people, and the monetization of hope and greed, is a way to make a huge amount of money. It's just astounding to me how willing people are during a bull market just to toss money around because they think it's easy, and of course that's what they felt about internet stocks a few years ago. They're thinking about something else next year too, but
what he means there is that it's just that like people always come up with an idea like options, shorting stocks, man, crypto's the next big thing, NFTs. There's always some hype, but it never works.
Biggest money made, in Wall Street in recent years has not been made by great performance, but it's been made by great promotion, basically.
So that I love saying that. I always tell people that Wall Street doesn't make money by performance. They make money by promotions, as in downgrading stocks, upgrading stocks, having news cover it, putting it out in articles. Like, remember, these article people and bloggers, they get paid to write articles. They don't write articles to get paid, and there's a big difference in that.
Charlie, do you have anything?
Well, I would state it even more strongly. I think the current scene is obscene. I think there's too much mania. There's too much chasing after easy money. There's too much.
Will you still look for the
television emphasizing speculation?
So I read about your investment in Korean stocks for your personal portfolio. My question is, if you're managing very small amounts of money, like say 3 million or 10 million, will you still look for the Graham's approach for low PE and wider discount to book value? Will you still look for these kind of situations if you couldn't find any franchise stocks?
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money, but there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in, and I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon, I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap.
That's something that I always tell people. Like that phrase, that little saying is so funny. Like he didn't even know how to pronounce these stocks. It just goes to show that like he really just focused on the numbers. He didn't care about having an amazing company with the best growth and the next Amazon, the next Tesla, and this and that. He couldn't even pronounce these names. They're Korean stocks. And that's another thing. Don't just try and close yourself in on the US. There's amazing opportunity in the Japanese market, in the India market. I've seen things in Spain and Italy. So that you can expand outside the US. Sometimes a certain region or a certain country is very undervalued compared to the US. So you can put money on somewhere else and make the best out of that. Anyways, that's a whole different talk.
That you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future, I would have bought that also. Incidentally, I've written in the last annual report about Geico, and I bought that stock in 1951 when I had about 10,000.
Many of the best value investors are buying high-quality, multinational Japanese companies that are trading below net working capital value. Do you agree that these values exist in Japan, and would you consider the purchase of some of them?
Well, Henry Emerson, who publishes the Outstanding Investors Digest, is here, so I will give a tout on it. I read the Outstanding Investors Digest, OID, and it's a very good publication, and I have read some of the commentary about Japanese securities. We've looked at securities in all major markets, and we certainly looked at them in Japan, particularly in recent years when the Nikkei has so underperformed the S&P here. We're quite a bit less enthused about those stocks as being any kind of obvious bargains than the people that you read about in OID. The returns on equity in most areas of Japanese business, returns on equity are very, very low, and it's extremely difficult to get rich by being the owner of a business that earns a low return on equity. We always look at what a business does in terms of what it earns on capital. We want to be in good businesses. What we really want to be is in businesses that are going to be good businesses and better businesses 10 years from now. And we want to buy them at a reasonable price. But many years ago, we gave up what I've labeled the cigar butt approach to investing, which is where you try and find
Okay, so what he was just talking about was like stage 2, when you're already finding stocks that you do want to hold for 10 years that do have money coming in. That's a little different, and they're worth a little bit more. And then right now, he's literally just talking about like he gave up stage 1. Like that's like where he already transferred.
A really kind of pathetic company, but it sells so cheap that you think there's one good free puff left in it.
And he said it himself, it's such a pathetic company, and that's the kind of problems I deal with. People always make fun of me for the kind of stocks I'm buying because they look at the chart, they just don't know they're so worthless, but there's money to be made. And then you make millions, and then you can focus on the next thing and make even more.
We used to pick up a lot of soggy cigar butts, I had a portfolio full of them. And there were free puffs in them. I made money out of that. But A, it doesn't work with big money anyway, and B, we don't find many cigar butts around that we would be attracted to. Those are the companies that have low returns on equity. And if you have a business that's earning 5 or 6% on equity, and you hold it for a long time, you are not going to do well in investing, even if you buy it cheap to start with. Time is the enemy of the poor business, and it's the friend of the great business. If you have a business that's earning 20 or 25% on equity, and it does that for a long time, time is your friend. But time is your enemy if you have your money in a low return business, and you may be lucky enough to pick the exact moment when it gets taken over by someone else, but we like to think when we buy a stock we're going to...
That's what I was talking about earlier. That's happened to me. Like sometimes the stock it's like not that great. Well, here's two things. The great thing about it is that you have such a high margin of safety. So if it's worth $10 and you buy it at $5, and it's not the kind of stock that's going up in value or it's just straight, it's losing a little bit. which first of all, you can predict. You can see like, oh, it'll take 7 years for this company to become worthless, or 5 years. I have enough time. But anyways, that's happened where like someone steps in and just merges with them or buys them out for their current fair value. Sometimes even more. Sometimes companies just don't want to sell at fair value, and you make that instant profit, which is great. But it goes back to the point, you're not holding these stocks forever. You're just compounding your money. You're making, and I don't want to say quick money because it's not a get rich quick scheme type of thing, but you are compounding from 10 to 20, from 20 to 40, from 40 to 60, and you're able to do that. Then you go on.
Own it for a very long time, and therefore we have to stay away from businesses that have low returns on equity. Charlie?
Yeah, it's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke.
Those are little things that you can see on the balance sheet. So, I mean, there's two stocks. You have dying companies and growing companies. I like the growing companies, the companies that are stable or growing, or they're just, they can pay off everything and be fine, versus the ones that are dying, which, again, that's a whole different topic, but just to give you an idea.
We've been in a few of those too. Yeah, Charlie and I, we or at least I've owned stock in an anthracite. That don't know what anthracite is. Street railway companies, windmill manufacturers. What other gems have we had, Charlie?
Textiles.
Yeah, textiles. Don't even think. Yeah, Berkshire was a mistake, believe it or not. I mean, we went into Berkshire because it was cheap statistically, just as a general investment back in the early 60s. And it was a company that in the previous 10 years had earned less than nothing. I mean, it had a significant net loss over the previous 10 years. It was selling well below working capital. So it was a cigar butt. And it was, I mean, we could have done the things we've done subsequently from a neutral base rather than a negative base, and actually it would have worked out better. But it's been a lot of fun.
This question concerns the so-called Wall Street professional. Are Wall Street professionals usually more accurate in their near or long-term market trends, forecasts of stock market trends? If not, why not?
Well, we've been following that interesting question for a generation or more, and I must say frankly that our studies indicate that you have your choice between tossing coins and taking the consensus of expert opinion, and the results are just about the same in each case. Your question as to why they are not more dependable is a very good one and an interesting one, and my own explanation for that is this: that everybody in Wall Street is so smart that their brilliance offsets each other. And that whatever they know is already reflected in the level of stock prices pretty much, and consequently what happens in the future represents what they don't.
Okay, well, that is the end of the videos that I wanted to share. But I just wanted to really give you an idea that Warren Buffett hints at these stages. And I'll have to make another video with Seth Klarman because he talks about this as well, and Joel Greenblatt and a few others. That last clip is Benjamin Graham, which is pretty much who fathered value investing and taught Warren Buffett everything. And he's just talking about how, like, you trusting these analysts and these firms and the big money and stuff, it's a coin flip. I mean, they can, for lack of a better word, they're idiots. And it goes back to what we were talking about earlier. Like, they make money off promotions, not off performance. But yeah, that about wraps it up. And that's everything that I wanted to share with this video. But I hope you guys learned something and understand just like, you should really be focusing on these small stocks to make a lot of money in the stock market, and then move on and just be careful who you're following. Try not to do what big money is doing, because you have better opportunities picking your own stocks with small money, with small stocks, and where nobody's paying attention to, that have higher return on investments. And I have a whole other video that I just posted on YouTube, the last one, that goes over is value investing dead, and how like value investing doesn't make as much as growth stocks, and it's all a lie. And I kind of talk about it in the other one if you want to watch that. But anyways, that's it for this one.